Lloyd, thanks for your time, man. Like I said, it's been incredible to watch the growth and the progress of Sharp Alpha. And, obviously you guys focus on what you call competitive entertainment. So I want to start at the inception of the fund and how you define that term and how you kind of started to form a thesis around it.
Yeah, I appreciate it, man, and great to see all the growth of your platform and your following as well. We focus on what we call competitive entertainment. We define that as any form of entertainment where winning matters, where caring about outcomes is the primary source of utility for the end customer. And the reason for that is that we see in an ever complicated world that not only is time people's scarcest resource, but really it's their attention that is the cash value of their time. And in a world where everyone is increasingly competing for attention, we think it is the experiences where people have a vested interest, where they really have skin in the game, that break through. And I certainly know that the things that capture my attention the best are usually the ones where I have some sort of vested interest in the outcome. And for us, the way we see it, when people have skin in the game, they derive all these great second order benefits, connection, community, a sense of purpose, and that if you audit yourself and say, what do I have to show for all the money I've spent as a gamer or a sports fan over time? I think the real value that you've got in return is that sense of purpose and connection that fandom has given you and that still enables in you. And we think it's only going to become more and more important going forward to find experiences, products, services that capture people's attention and break through the noise.
I love that, man. And when you're evaluating these type of opportunities or deals that come across your table, what are some of the outliers that you're looking for? Because obviously, as an investor, there's certain baseline or foundation that I think most investors kind of have or look for in opportunities. But what are some of the things maybe outside of that that are green flags for you guys in your fund?
I mean, we love people who are scrappy and resourceful and have really clear vision and are thoughtful. I think the way we try to sum it up is that, the ultimate green flag is that you come across as a founder whose future earnings we would want to own a stake in, regardless of what you were pitching us today. And that's a question that we ask ourselves at the end of every diligence process. I think all the good things that a founder can do, they end up getting rolled up into that one question, which is why we find it to be a useful heuristic. And so I think positioning yourself as being uniquely positioned to solve the problem that you're solving, coming across as totally dedicated and focused. You are not going to be able to sleep until this idea comes to fruition and is the only solution for X. I think the more that it's hard to fake any of these things. I think you have to find the right opportunity for yourself to create that perception. But that's how we look at it from our side. We also sometimes like the test. Is this someone who makes me so excited about what they're doing that I kind of want to quit my job and go work for them? Now, that can be a bit susceptible to people who are just really good salesmen, but still, being a good salesman is absolutely critical. If you're going to launch any business, you're going to need to not just persuade, but inspire investors, other employees, customers and clients, regulators. I mean, all the steps along the way will involve some degree of salesmanship. So that's a second question that we do like to ask ourselves.
Got you. That's really insightful. Looking at the broader macroeconomic, landscape right now, a lot of people will say that it's a very hard time to raise capital, but you all were able to successfully close your second fund. I think $25 million, was it?
Correct.
Um,
That's what we announced, correct?
yeah. So how were you able to convince LPs to back this second fund given the macroeconomic environment?
It is a brutal environment out there, and I sympathize for founders and fund managers alike who are out there trying to raise capital, especially pre-launch, pre-product market fit. It can be tough. For us, we have a very specific and unique strategy and way we structure our deals that I won't give away our secret sauce here, but I think in part the fact that we have been successfully executing on this strategy is why we were able to get some folks to re-up significantly. into fund two. And we are honored to manage capital for a number of the largest publicly traded companies in the sports, gaming, and entertainment verticals. And I think, again, without giving away anything too specific, the way we position and structure ourselves, not only to do that, but to use that to our advantage, is why we've been able to generate stronger returns than is average for the vintage of our first fund, and probably why we're able to get our second fund together relatively quickly in a really tough environment.
For sure. One of the things about gaming and betting companies is they burn a lot of cash, specifically on user acquisition. So, what business models or metrics kind of convince you that these companies will be able to scale and survive long term?
I think payback period is one of the best. It kind of cuts across really not just B2C, but B2B businesses. But it automatically adjusts for what you're spending on customer acquisition, and you can compare it for one industry where someone has very valuable customers that are expensive to acquire, and another where someone has less valuable customers that are cheaper to acquire. And I feel like that is the one high level heuristic that's the best to start with. If you have a really sexy payback period, make that the first bullet point in your email, probably, maybe even put it in the subject. Obviously, others would include, LTV to CAC, ROI on marketing spend over, let's say, a 12 or 24-month period, depending on the type of platform, the GMV retention or net dollar retention. If a cohort of customers spend $100 on the platform in month one, how much do that same set of customers, how much do they spend in month two and month three and month four? I think these are some of the metrics that we like to see. And there's some really amazing businesses out there with 3-month payback periods or less in this space. And I think one of the reasons why they are burning a lot of cash is, at least I hope, that they have internal models that suggest it's going to be very profitable to do so. And you can certainly afford to spend quite a bit on user acquisition if those customer acquisition costs are being paid back to you within 3 months, and you're 2 or 3xing that spend within a 12-month period.
For sure. Getting back to this idea of competitive entertainment, obviously that can encompass a lot of different subsectors. Are there any particular subsectors or verticals you all are most bullish on or most interested in over the next, like, let's say, 3 to 5 years?
We try not to think too verticalized in that way. There are things about the world that we see changing and that we are bullish on. We think people want to be socially connected and find like-minded individuals more than ever. We think there's a big push to put down the mobile phone, silence the notifications, kind of reconnect either with nature or with friends or with family, whatever it is. There's obviously a big health and wellness push these days. People still drink alcohol, of course, but not nearly, in the same ways. It's not a centerpiece for socialization in the way it once was. And those are things we believe about the world. We have a view on what constitutes a great founder, and what makes us feel like a founder is someone whose future earnings we want to own a stake in. And I think beyond that, we look for the founders who pitch us to tell us why some subsector that maybe we had never even heard of or thought about is the next big thing or is experiencing a watershed moment, and that they are uniquely positioned to see the opportunity and execute on it. So that's a bit of a non-answer, but it is how we think about verticals and themes.
Obviously, like this concept of AI integrating within technology and different industries is a hot topic these days. How do you see it playing a role in sports betting and even gaming? Are there any ethical concerns that you all are thinking about when it comes to this as well?
Yeah, I have a background in AI and data science, and I sit on the board of some nonprofits dedicated to AI readiness and ethical, safe development of AI. It's an interesting question. I think in general, I try not to chase trends too much as an investor. I find that if you invest in the best founders and there is a new paradigm shift, they will find it and figure out a way to capitalize on it and integrate it into their business models, and derive significant gains from it. Certainly, sports betting is an area especially ripe for AI or machine learning deployments because really what AI and machine learning does at its core is pattern recognition. And the sports betting industry is one more than almost any other where the entire tech stack is rooted in pattern recognition. Fraud detection, who's trying to exploit, are these users real or fake? KYC and AML, do we have faith in the source of these funds? Setting odds. What should the odds be for this game or for this bet? Knowing how to change the odds as the bets come in, depending on what type of customers they come from. Figuring out how to assemble the home screen. What menu comes first? Do you put baseball before basketball? Stuff like that. Every single thing that I just described is a pattern recognition an inference problem at its core, and that's what AI and machine learning tend to do best. So I think you've already seen and probably started to experience, even without knowing it. I think some of the impacts of that integration, and I don't think that will slow down anytime soon.
Yeah, absolutely. One of the things that you said earlier kind of caught my attention about people putting the phone down and really getting back to that social interaction, in-person connections. And I think one of the companies you all recently backed, Ballers, I think encompasses a lot of that social component of playing a sport together. And I think I'm really interested in how sportainment is becoming more prevalent and these niche emerging sports are really kind of taking a hold in the industry. So can you talk about that deal? What about the Ballers business model was particularly appealing for you guys and how you saw it long term being scalable and a good opportunity for the fund?
Yeah, sure. Most people don't usually think of brick and mortar build outs as being your typical venture investments. In this case, without getting into too much detail, uh, the way the company is structured with effectively different share classes and the way we structured the investment round actually do provide a very compelling path to venture scale returns in a category that might not historically have been thought of as doing such. And that is not really to our credit, is to the credit of the amazing founding team at that company that as soon as we spent some time with, we realized this is the team that you want to back for probably a lot of different projects, but especially for a high-end luxury hospitality centric members club for indoor racket sports, indoor golf simulators, and things like that. And as mentioned, we are very team and founder oriented, and seeing that they checked those boxes was a big early one. The way the deal and company was structured, such that we're investing in a high margin asset light vehicle, is another thing that helped get us over the hump. And then to your point, it's really a belief that certainly in New York right now, there are social clubs with members lists, that are thousands or tens of thousands of members long. If you want to try to get, especially an indoor pickleball or paddle or tennis court on the weekend in New York City, forget it. It's almost impossible. The demand exceeds the supply by so much. And certainly everyone has seen the growth of pickleball in the US. I think paddle is going to quickly surpass that growth as it becomes more prevalent in the U.S. market. And what we like about Ballers is that they are not a paddle company or a pickleball company or a squash company or an indoor golf company. They are a diversified entertainment venue where, if it is the case in the future that pickleball is not popular anymore and some others and highlight suddenly, becomes the most popular, it's not so hard to sub out some of those courts. It's really about creating a country club feel in the city where it's a second home for people. They treat it like a second home, and excuse me, and they see it as a source for purpose and for social connection through competition. And certainly Ballers is not the only company tapping into this theme, and we think it's going to be a category that has quite a bit of growth ahead of it.
Obviously, there were some other pretty prominent investors and athletes on this cap table and is involved in this deal. How important was that for you all? Do you guys look for athletes who have star power and brand when looking at some of the opportunities or deals that you've done?
Yeah, I think sometimes it can be a distraction, and sometimes it can actually almost be harmful. If you have an athlete who doesn't have much firepower, maybe, but thinks they do, and wants, to be more involved than they should be, and maybe is not perfectly complementary to the brand, you still will get people who chase after them because people want to be around athletes and celebrities and things like that. So I don't think it is universally the case across the board that it is always profit maximizing to involve any athlete or celebrity investor that you can. I think generally, if you are getting an A-list, if you are getting truly one of the top 10 most famous people in the world involved, it's hard for that to be a bad
Yeah.
thing. But the majority of announcements that you see are, even with A-listers, they're not the top 10 in the world. They're, maybe top 100 or, or in cases outside of that. In terms of ballers, where it is a very illustrious group, there are a bunch more really exciting ones that will be added to it that you'll see announced. But for our Philadelphia venue that's opening, certainly they've announced a lot of the Philadelphia athletes so far. I found it very important and accretive to have their involvement in this deal. The way this company and the Philadelphia venue, for example, succeeds is in part by it being seen as being cool and
Mhm.
having some status attached to it, and it being the kind of place where if you're a member, you might get to bump into an athlete or celebrity who's playing on the courts there. And so for that kind of opportunity, I think it is incredibly valuable to have the type of star power that we have announced and will announce. And certainly there are other deals that I would also describe that way in our portfolio, where it's not just about the vanity or the pageantry or the announcement. There really is genuine value to the business model and having the validation and the trust and the elevated branding that many of these people can bring to the table.
Absolutely, absolutely. Getting back to gaming for a second, I want to talk about some of the, or even betting, the regulatory challenges, the legal hurdles that I think a lot of founders have to navigate when they're getting into this space. How do they navigate this complexity, especially when these laws and regulatory challenges can differ from state to state or country to country?
Uh, Usually, you hire a good lawyer. Maybe more and more these days, you use ChatGPT for some of the basic work. I think it's one of those things where it's kind of a blessing and a curse. It could be a feature or a bug. When you're a pre-revenue, pre-launch founder who just has an idea and hasn't raised any money and doesn't have any of their own money, it feels like a really big impediment and a big hill to climb, to have to get licensed and regulated and pay taxes and special gaming taxes and go through probity, and even to have the administration to fill out the licenses, let alone the balance sheet. When you're on the other side, once you've succeeded in securing the license, it becomes a barrier to entry. It becomes a significant moat because now other competitors will have to go through that as well. And so I think it's just it's like anything in startups. There's no solution, there's no right answer. It's a trade-off. Uh, you can go the route and say, I'm going to get regulated, and that way other people will have a harder time competing with me. Or you can say, I'm going to do something creative that doesn't require regulation, or I'm going to do a B2B business, which still has to be regulated in sports betting, but usually with less intensity than a B2C business. And so it's just part of the equation. It impacts how much money you'll need to raise and how much capital you might need to have before revenue starts coming in. But these are all just, I think, different parts of the equation someone should think about when they're thinking about what type of business they might like to start.
For sure, for sure. As we wind down here, a couple more questions. For a founder who's looking to raise capital in today's world, what advice would you give them on how to break through the noise and get in front of firms such as yours?
Um, I think there's sort of a, be so good they can't ignore you is what Mark Andreessen likes to quote from Steve Martin, which shows that it applies, I guess, both to, being a performer and being, an investor or startup founder. And I think usually what that ends up translating to is something like, maybe get yourself to the point where you don't need to raise money. Do some bootstrapping. People are calling it seed strapping these days, where you get some more product market fit under your belt before you first go out to investors, unless you have, previous successful comparable exits or something like that. And, it varies based on specific business model. If you're in biotech or pharma, you're not going to be able to release a new drug without getting some funding. So certainly it's less practical advice in some areas than others. But I think just having incontrovertible evidence that your idea is going to have its day in court, that you are the right person to bring it to market. I think if you have those things, people will notice.
Last question. Looking at the broader gaming or sports technology market, what's one broad prediction that you have for the industry over the next year?
It's a tough one. Um, I will, instead of giving a direct answer to that, I'll mention one that has turned out nicely, and we're glad to see people coming around to a bit more these days. I feel like investing in creator-led holding companies is all the rage, and there's new VC funds that just invest in creators. We were the first investors years ago in Friday Beers, or their parent company, Almost Friday Media. If you don't follow Friday Beers on Instagram, go ahead and do so right now. They are hilarious. And at the time, there were a lot of people who were sort of dismissive of what we thought a creator-led holding company could turn into in terms of its margin profile, revenue growth rate, ability to pursue really large and substantial commercial opportunities. And now, I mean, Almost Friday Media has renewed their deal with MGM probably for the fourth year now. They have a podcast with Johnny Manziel and Fanatics. The content they put out, frankly, most of it's better than what you see on Netflix, I think, these days, and with the production values to match. And it's an interesting one to see. There are a lot of people out there who talk today as if it were always a foregone conclusion that it made sense for VCs to look at creator-backed holding companies and media platforms. But only 4 or 5 years ago, that was definitely not the wisdom. I think it was actually quite contrarian at the time, and we're so glad to see how well that company has done in particular. And a lot of our friends and frequent co-investors now are making similar plays in adjacent companies.
Lloyd, man, this has been great. Super insightful. Appreciate your time. Lastly, can you let everybody know where they can learn more about you and Sharp Alpha as well?
Yeah, LinkedIn is probably where we're most active, a little bit on Twitter, but give us a Google search. You'll find us on either one, and reach out either way. We're always happy to hear from anyone who's building anything interesting in the space, or making some cool investments that we might find compelling.
Perfect. Thank you, my friend. Appreciate it.
My man, be well.